All right. Well, Am I coming through, James? It's having a little bit of microphone issues.
Yeah, it sounds significantly worse than usual.
Okay. All right. Let me switch this.
That's sounding more normal now.
Yeah. All right. I should be coming in now, right?
Yep.
All right. Awesome. Well, ladies and gentlemen, welcome to the Capital Flows live stream. Thank you for being here. We have multiple developments. Obviously, equity markets are a little down on the day. As expected, people are probably panicking, but that's why we're going to have this live stream. We're going to talk through the different price action changes that we are seeing, how it connects to the CPI print this morning, and we are also going to build on everything that we covered yesterday. So if you were not here yesterday, the most important thing that you can do after we get off this stream is begin going through the different changes that I laid out yesterday in yesterday's live stream. So if you haven't yet, go to capitalflowsresearch.com. Right here on the main page, the impossible trinity behind the melt up. If you don't understand the impossible trinity, then you are missing the largest factor for macro liquidity that is pushing markets up, independent from the AI retooling that we are seeing right now. And so what you need to do is go through all of this overview, and then you can also download the slide deck, go through James's recent videos, and begin to understand the different changes that are taking place. The key thing that you want to realize about all the work that I'm putting out on a daily basis right here, changes that are taking, is that when we have a macro regime, there are so many different factors that are taking place. And the only way that you can actually understand things in real time is by building and stacking the knowledge that we're laying out in the live streams every single day. So if you are here, we're doing a live stream every single day. Myself and James will be here at 8:30 a.m. Mountain Standard Time at the same time every single market day. And we'll be covering the entire breakdown for the macro regime. The place that I want to start is actually with a tweet that I shared. And this will really frame how to connect macro liquidity with AI. And then I'm also going to connect it with some of the latest developments in the PER thesis that I've been laying out and how that connects to everything else. So this tweet that I sent out this morning says the credit cycle melt up is about macro liquidity, and AI is becoming both an input into that as well as operating within the context of more macro liquidity. So basically what I mean there is that a lot of people who map macro liquidity or maybe talk about macro, they don't really spend time understanding how the underlying tooling of AI is changing the mechanism. And I've written a report on this. If you want to go through that, you can go through that on the website, and I will link it below. The report that I'm referring to is published on May 4th. It's Walking the Thin Line, how AI is compressing the tails. And I talk about how CapEx and all those changes connect to the entire cycle that we are seeing right now. You can go through my entire thesis on AI right here, the AI reflexivity loop, published on February 20th. Again, just pull up this live stream and the recording of it and go through all of these in real time and begin working through these different slide decks. And again, all of these live streams are recorded. For people who are asking, the transcripts do process, but it just takes a day to process on YouTube. It's kind of out of my control. So if you go to the website, there'll be a summary there, and it'll break down everything for you. But the idea here that I'm sharing is that people will say, oh, well, AI doesn't really matter for macro liquidity or for this or that. It's just a symptom. It's just happening because liquidity is expanding. Not really the case if you actually look at the data. The underlying data is indicating that AI is retooling not only the economic system, but also financial market. Characterizing AI as simply falling into the macro system misses the fact that it is fundamentally retooling how money flows in the system. This will be one of the main things that I cover today. Now, the idea here is that AI is changing the inputs and outputs for the S&P 500 and for earnings in the underlying economy. This is why we have actually seen layoffs happen and then also earnings rise. That's very distinct in the entire cycle that we're in. And so when you are understanding and trying to get a read on the credit cycle and AI, again, go through this entire report that I did and published on May 4th. It is just going to be critical for you to go through that because it lays out how AI is retooling the production function of the entire economy. And this is a similar setup to 2021 with one substitution. The constraint is no longer monetary, is technological. And again, you cannot, if you are trying to map and track macro liquidity, you cannot ignore the AI flows. And the reason for that is that it is one, retooling the economic system, but two, because we are in an AI arms race, the geopolitical flows around it are also a factor pushing capital across different borders. We are in an AI arms race, a space race, and many other technological races with China right now, whether people like to admit it or not. We actually just saw in the news yesterday about more Chinese agents that are actively trying to make their way into society and subvert things. And so,
shout out to Eileen.
Shout out. Guys, there is such a dominant force. And again, China is not playing by the same rules that you think is fair. I'm like, oh, well, they have to tell us if they're going to be a spy. Right. Got it. Okay. Little naive there. But the entire idea is that there are malicious actors in the system. And just saying, well, as long as I get my Bollinger Band range and ES right, then it doesn't really matter. The importance of understanding where we are in the cycle connects to these larger forces that are at play. So again, go to capitalflowsresearch.com and go through of understanding all of these different changes that are taking place and keep up to date on all the articles that are being published. capitalflowsresearch.com. This and go is going to connect all of these different changes that are taking place.
Hey, sorry. The audio is playing.
This
from your
is
system.
going to connect all of these different changes that are taking place.
Hey, sorry.
Thanks.
Yeah.
We good now?
Every time it goes to that page, sorry, it just starts playing and I could hear both of you.
Okay. Thanks.
Yeah.
Okay. So how does, what I want to do is connect this entire idea that AI is retooling the entire changes from macro liquidity. Again, people don't want to address that or talk about it. And the main reason why is because you probably have to go do a bunch of work on how AI is actually functioning in terms of its connection to OpenAI, Anthropic, memory, data centers, CapEx build out in the underlying economy. Again, people don't want to spend the time on that. However, on the public market side, the most important factor that you need to think about for AI and the impact it's having is hyperliquid, because hyperliquid is becoming the one-stop shop for perpetuals and a way for agents to permissionlessly express trades. And the key factor here is that when you think about hyperliquid, and I just published a tweet on this that I'm going to walk you through, the key thing about hyperliquid is it's not about crypto. It just happens to be on crypto rails. Perpetuals and perpetual derivatives are the most innovative, disruptive derivative financial product that we have had in years, if not a decade. And it is going to fundamentally change how leverage is distributed in the system. And we have just as of today seen a major progression forward on the regulatory front with the addition of the ETF. Now, this is the tweet that I laid out because if you have been following me for any period of time, you know that my largest position has been PER, which is a hyperliquid ETF. I've been long since the low threes, and I'll pull up that chart right now. And I've been long since down here in the sub 350 area. If you were a paid subscriber, you got all of those notifications. And then I've been posted about it publicly after we went in the money. And I've been continuing to post about it, especially when we're in these dips and explaining that there is further upside that is likely to take place. Now, Hyperliquid strategies per has been the only way to get access to the Hyperliquid coin for the entire year thus far, especially on an institutional front, an actual thing that's traded on the NASDAQ. That has been one of the major edges in terms of access that has pushed and given Hyperliquid the advantage, Hyperliquid strategies, the advantage in the Hyperliquid ecosystem. And the change that we saw today is very positive on a regulatory front. So we just had the new ETF come out, which is the first Hyperliquid ETF. And if you go to, I'm trying to pull this up right now. Where are we at? So if you go down to the thread that I retweeted, the THYP ETF is the most recent Hyperliquid ETF that has come out. Come on. Here we go. And what you can see is the ETF is now trading. We have, about 10,000 shares traded in the last couple of hours. And this is going to function as a new development on the regulatory front because it's very clear that regulators are allowing Hyperliquid ETFs to get added to the system. And watching the volume in the Hyperliquid ETF now will be very critical. We're very likely over the next couple of weeks to have more additions in Hyperliquid ETFs as you have more and more regulatory progress. Now, when you have these additions to the ETFs, it's very unlikely that regulators are deciding to add ETFs to the system. And it's very unlikely that the S&P Standard & Poor's are signing deals with Trade XYZ, which has already happened. That is the largest perpetual builder on the Hyperliquid blockchain. It's very unlikely that they're allowing that to happen if Hyperliquid is going to continue to be banned from the United States. It is, we got already added to Coinbase and Robinhood, so we're now bringing more access to the system. The question that a lot of people have been asking, and rightfully so, is about the Hyperliquid Strategies treasury company. And the idea is that if PER was the only way to get access to Hyperliquid, especially on an institutional basis, and especially as it's publicly traded on the NASDAQ, then the question is, does PER now become irrelevant? Because they're no longer the only way to get access in size to the Hyperliquid token. And here are my thoughts and how I'm positioning around this specific idea. And we're going to connect this back to the larger macro context for why right now, this is, in my view, one of the most asymmetric, if not the most asymmetric bet in markets right now. First, this is a major development in the ecosystem I laid out. Hyperliquid has always been focused on creating value as opposed to just getting in front of flows. This will continue to distinguish the protocol from other tokens that are just trying to pump the price at the expense of long-term holders. I explained that entire mechanism here. And what I would do is click on this link right here, and you can go through this article that I wrote where they sold everyone a lie and then became the establishment. This idea is what has happened to the entire crypto industry. You have all these larger crypto players who have become millionaires and even billionaires by basically selling lies to the entire system. And now the entire system has, the amount of crypto projects that are around that are still working is just so astronomically small than it was several years ago. And so you have the entire establishment. They've just become, an entire group of people have just become the new establishment. And they've made a ton of money, whether that's in media or whether that's in just selling their tokens early or just getting an early round, talking about it online and then selling their tokens in a pump and dump. They sold everyone a lie and they've become incredibly rich, and the entire system has gotten hurt because of it. which is why when Hyperliquid comes in and says, hey, we're not spending any money on marketing, we're also not taking any VC money. And oh, by the way, we're going to create so much value that everyone comes to us instead of us just trying to get an ETF launched. And so that is a fundamentally different mechanism where Hyperliquid has created so much cash flow and it has created so much value prior to any addition of ETFs or anything else. And so when I go over this, I talked about this entire idea in the system that was taking place, and I published this entire idea last. I'm trying to remember the exact date of it. It was earlier this year. Let's pull it up. January 16th. So if you were following the work that I was putting out, and if you had notifications on January 16th, you would have got this entire report, and you could have said, oh, you know what? I want to get long Hyperliquid and Hyperliquid strategies and PER, because that was all published on January 15th. Now we're several months through the year, and we are significantly higher now. And so here's one of the things that I am always focused on as well, is that I don't buy into this whole idea of don't talk about hard issues. I completely reject that idea. I think if there are actual risks in the system or there are actual issues that need to be addressed, you need to address them head on. And there's going to be a lot of people that ignore a lot of different changes that take place simply because they're hard conversations to have. And what I always say is that when you are creating true value and it gets tested, then whatever that product is, if it is truly valuable, it will rise to the occasion. And so that is the idea that I want to lay out in this tweet right here, is that first, we have the distinction of Hyperliquid itself, and now they're differentiating themselves. Second, you need to be watching the volume on ETFs and how many tokens it can accumulate, because it's going to be a major factor in flows moving forward. Very simply put. Third, the question is, how does this impact PER? Since the ETF is launched now, should we get out of PER? Should I begin to sell my position and get out of PER? Or is there actually something more at play that you need to be aware of, where there could be a situation where you might even want to double down on PER because they can add value in excess above the spot hype returns? And that's what I want to walk you through right here. The third thing I laid out is that PER, I've been a long time, I've basically been holding it for a while now. We're up 100%. PER has been the primary way to get exposure to the hype token in traditional markets, and this is now changing. When PER is the primary way to get exposure, it is possible for it to trade at a premium or discount, as larger players have to move the market to adjust their positioning. So when we have an ETF come out, traders can begin arbing the ETF against PER, or PER against the ETF, or whatever way you want to, depending on if we're at a premium or discount in PER, and create much tighter ranges on the upside and downside for PER relative to the underlying net asset value. If you want to go through the entire thesis on this and how it works, I laid it all out right here. You have an indicator there that also maps the fair value as well. You can also go to the PER website to map where we're at with the price to the underlying value. So the idea is that now that we have an ETF coming out, now that it's out, traders are going to analyze PER, and because there's not the same access limitation, then just because of access, not because of other factors, but just purely because of access, people can now make the decision, do I want to buy the PER treasury company, or do I want to buy the Hyperliquid ETF? That's a real decision people need to make, which means that me as an investor, I need to think about, what are other people thinking about? You can't just have this utopian view about, well, we just have some good vibes around PER, so it's a good idea to just buy that instead of the ETF. No, you need to actually ask hard questions and say, can PER provide excess returns or additional value or less risk than a basic Hyperliquid ETF? And my belief and the entire thesis that I've been laying out is that there is a very high potential for this if leadership is executing in a very strong way. And the question will be, does the addition of the ETF change the entire proposition for PER? And my answer to that is that it depends on leadership of PER and how they provide value. So simply put, if the leadership provides value so that the amount of shareholder value they provide is in excess of the underlying token appreciation, then that is why PER can trade at a massive premium to the underlying holdings. At the end of the day, a treasury company has a function in markets that is different than an ETF. This is key here. The actions of a treasury company is them providing returns above the underlying. The ETFs create more access so that the probability of a premium to NAV occurring due to access issues is decreased. So that means that just simply based on access, it is a lower probability that PER trades at a premium because there's now more traders that can arbitrage the difference between them. Now, what you need to ask is, okay, a premium has a lower probability of occurring because of access, but is there a probability or even the direction and potential of PER trading at a premium, not just because of access, but because the leadership is adding value in excess of the underlying holdings? And so I laid out the five-part breakdown basically of how I'm thinking about this. The entire question now moving forward that you need to ask for PER, and the question that leadership is going to begin to push more, is how can we provide value above what a simple ETF can provide? Because now we have access. So you now have to say, okay, now we have an ETF, but what can we do that an ETF can't do? It's very simple in the same way of any financial derivative or any company in the economy. If you can do something that is differentiated from what others are doing, and it provides significant value to shareholders, you will be paid for that action that you take and for the risk that you take. And so the PER treasury company has the ability to still issue shares and buy back when it trades at a premium or a discount at NAV. This is still fundamentally different than a basic ETF. So the CEO of PER, David, and then also the one of the directors on the board, Bob Diamond, they've done a great job at this execution thus far. This has allowed PER to actually outperform hype and be a significant advantage to shareholders. PER has this just baseline of them being able to buy and sell shares if we do have a market dislocation or if we do have any changes is positive optionality that an ETF doesn't have that can be accretive to long-term shareholders or just to basic shareholders, not even just long-term shareholders. Number two is PER has access to a credit facility that an ETF does not have. So now you can have the treasury company actually leverage up its exposure in a way that the ETF and a spot ETF can't. This will allow the PER leadership to continue to execute its strategy of issuing shares at a premium and buying them back at a discount. This will be, I think, one of the really key things here. And then also on top of this, we have a very clear connection between hyperliquid strategies and PER and also trade XYZ. And that will be one of the key things that I want to talk about in a moment, because trade XYZ on hyperliquid is going to be the most kind of important manager of all the derivatives that are on the hyperliquid blockchain. And fundamentally, PER has a significant advantage in the market since it is buying back shares. People still don't really appreciate this. The market appreciates it, but popular narratives don't. Because what we have seen over the last several of years is that treasury companies only issue shares, they never buy them back. Every single Bitcoin treasury company, every single other ETH or Solana or whatever it might be, what they do is they sell shares when they're at a premium, but they never buy them back when they're at a discount. And it's just showing that they will dilute shareholders and do something at the expense of shareholders if it means being able to accumulate more tokens for the company. But that is fundamentally in opposition of the entire thesis and goal you should have as a treasury company, which is to provide excess returns for shareholders. So this is very different when PER and Hyperliquid Strategies is buying back shares when it trades at a discount, which they've been consistently doing with the cash they have on the balance sheet, and which they're going to continue to do, in my view, with the credit facility that they have. Then that separates them and differentiates them. And this is very different than any other popular treasury companies who only dilute their shares at the expense of shareholders. An ETF doesn't have this ability to take advantage of market volatility. Number three is PER has the ability to take out credit by hype, therefore leveraging its balance sheet like any hedge fund type of vehicle that is trying to increase its exposure. If this happens, this creates optionality for PER over an ETF. One of the other things that it can do is it can use its cash or it can use its credit to be able to acquire or make additional investments in the Hyperliquid ecosystem. Again, people aren't really talking about that, but they have the optionality and ability to make moves like that because they have relationships not only with the Hyperliquid team and Trade XYZ, but many other individuals in the ecosystem that where you can have PER not only function as a Hyperliquid treasury company, but if they decide and leadership decides, they could also function in many ways like a VC fund. And they could begin adding other types of ways to generate capital, generate returns on their balance sheet. And then number four is PER has the ability to generate yield on its hype holdings that can allow excess returns relative to the hype spot price. Similar to any hedge fund type of vehicle, PER has many different ways of generating yield through market dislocations, extracting returns from premiums in markets, and partnering with the Hyperliquid team to create a stronger bridge between the Hyperliquid ecosystem and traditional financial markets. The most significant opportunity, so this goes back to the ETF just came out. Everyone, I'm sure there's going to be some people that say, oh, now I need to switch from PER to the ETF. That's a totally valid thing. The thing that you would be missing out on is this exact point. Number five is the most significant opportunity for PER leadership will be functioning as a beacon in the decentralized Hyperliquid space to create bridges that would otherwise not exist. Because Hyperliquid has gone about building value in a manner that doesn't have typical institutional conflicts, many bifurcations exist in the industry that PER leadership can help bridge. So a lot of people like Jeff at Hyperliquid, who's amazing at everything that he's doing, he is focusing purely on the best-in-class product that he can build. There is another entire world of being able to take that best-in-class product and structure people around it and leadership around it and relationships around it so that you're able to create value on top of that product, as well as be able to facilitate trust and also monetization so that you can actually have additional value be added to shareholders and to consumers. So there will be so many opportunities that happen on top of the Hyperliquid blockchain that need a centralized rallying point that people can anchor to in order to build partnerships so that the whole is greater than the sum of the parts. The greatest companies in history, the way that they create exceptional value is by creating a whole that is greater than the sum of the parts. And the Hyperliquid Strategies leadership team has the opportunity to do this right now. PER has a unique opportunity to function as a rallying point for the decentralized players, such as the Hyperliquid team, centralized players that enter the space after the work of Hyperliquid Policy Center. So we're still seeing the Hyperliquid Policy Center make headway or make progress where they're able to push forward the entire conversation of getting Hyperliquid added to the United States. There still needs to be centralized players that help facilitate onboarding and consulting for these larger players that enter the ecosystem. And then the entire ecosystem of traders who actively move large size in the perps market, the entire crypto industry as well. You have all these players and you have the opportunity for PER and PER leadership to connect all these players to create a whole that is greater than the sum of the parts around the newest financial instrument of perpetuals. So a lot of this centers around the idea of perpetuals, and that perpetuals are already and continue to be and are going to be one of the most disruptive financial products that exists in years and likely even a decade that we have seen. And it is going to take over how leverage functions in the financial system. If PER sits at the middle of these relationships and actively facilitates them to further take stakes in other projects built on Hyperliquid or receiving various types of residuals as they build a whole that is greater than the sum of the parts, then they have the opportunity that no ETF can even possibly imagine. So the idea here is that Hyperliquid is a platform that is designed to actually produce value, produce cash flow, generate value, and have that value creation directly flow to shareholders in a systematic fashion. This is dramatically different than any other crypto project, and the track record for success for the Hyperliquid team and for Hyperliquid is already clear. So the idea is that we just moved into this moment in time where Hyperliquid ETFs just got added, which tells you we are making progress on the regulatory front. Per leadership in the system and their ability to help push everything forward is going to be the key thing to watch, because in my view, you should ask hard questions. You should ask and say, what is the value proposition of PER over an ETF? And when you begin to look through all of the potential that Hyperliquid strategies, PER, when you actually look at the potential that it has in the ecosystem and the gaps that exist in the ecosystem, you can begin to realize that the leadership has the potential to add returns that are far in excess of the hype spot price. And this is a significant opportunity for PER to provide value that no ETF that can provide. And this is why I continue to hold all my shares in PER, and why I think they have potential to do significantly more than the market can even imagine. I will continue to share my views on all of this. Again, go to capitalflowsresearch.com. I'm continuing to lay out all my views of this. I laid out some additional views last night for paid subscribers as well. My entire view right now, to pull it together, is that the addition of the new ETF is creating an opportunity for PER leadership to take an even more dominant stance and add even more value in the ecosystem, because they have the potential to, they really have the potential to create an entire infrastructure and community and value around and in the Hyperliquid ecosystem, and be able to ride the entire trend of perpetuals taking over really financial markets in a way that we have not really seen with any other company in history. Because every other treasury company, for example, like a Bitcoin treasury company, they're not building a ton on the Bitcoin network. They're not building companies on the Bitcoin blockchain that then produce cash flow. On the Hyperliquid side, you're actually having the ability to do all of that in actual financial products in HIP-3 and HIP-4 to dramatically improve leverage in the financial system. And so this is, when we talk about this, entire idea of how is AI impacting the credit cycle? How are we seeing the entire economy get bifurcated into either being a disruptor or a disrupted? When you look at all that and say, I want to take a bet stacking all of these edges, PER itself and Hyperliquid are the best expression of that, because Hyperliquid has the ability, and is already, but it is becoming even stronger in its dominance, where it is becoming the one-stop shop for perpetuals. And in my view, you are going to have Hyperliquid continue to generate more and more cash flow around these changes that we are seeing in perps. And we are already seeing, Hyperliquid deviate in its correlation from Bitcoin. And when we look at the underlying mechanisms and fundamentals, for example, in HIP-3, and we begin to say, okay, well, what are the underlying cash flows that are taking place? What are the distribution? Is this a kind of a diversified portfolio of a lot of different factors that are moving the market? And the answer is it is becoming almost like, if you've ever invested in real estate or a real estate portfolio, you know that if you have a diversified real estate portfolio, then you have a diversified set of cash flows that you're not overly reliant on a single asset class. And that is the same mechanism that is developing in Hyperliquid with HIP-3, where previously you had crude and Brent basically taking all the volume because of the geopolitical risk. But now you're seeing this shift, and you can see that all of these other names, for example, Circle, MU, all these other assets, especially individual stocks. I mean, people have no clue how big these are going to be on Hyperliquid. All of these other asset classes are beginning to turn Hyperliquid into a diversified base, and you have daily open interest still hitting new all-time highs every single week and month. And then when you look at HIP-3 daily volume as a percentage of the total, you still have pretty elevated levels. Open interest as a percentage of a whole is still really elevated. And as you add individual stocks, and we have this entire melt up in stocks that's taking place right now, that is going to set the stage for HIP-3 to take more of a dominant stance in markets. And we haven't even talked about HIP-4 and all the changes that are taking place in HIP-4, where the daily volume that is taking place is going through the roof, and we're already seeing pretty significant changes on that front. And that the HIP-4 side is only going to increase as more and more institutional changes and distrust really build from the entire poly market and Kalshi side. And so the idea is that all of these roads where you want to manage money and be able to access leverage in a way that is not limited by institutions, all of that is flowing to Hyperliquid. And it's why it continues to be my largest position, and why I believe that PER itself and the leadership of PER have one of the most significant opportunities in history to be able to add returns that are far in excess of the underlying holdings, because there is a massive gap in the market, especially in the Hyperliquid ecosystem, because it's developed in such a decentralized way without all the institutional conflicts. Now that value has been established and reputation and integrity has been displayed, now you can have the opportunity where players like PER are able, and the leadership of PER are able to create cohesiveness that begins to allow capital to flow through the system at a speed it never could originally, and is able to facilitate the creation of value and the monetization of that value that is far in excess than what any ETF could even imagine of providing. And so that's why, when we go back to this original tweet that I shared, that's why when I see an ETF get launched and people are saying, oh, this is the end, or this is not a good kind of development that's taken place, it's actually the opposite. Because one, that shows the regulatory front is advancing, and two, it now just sets the bar that much higher to create really exceptional returns, and for the Hyperliquid Strategies team to double down and say, we actually have an advantage that no ETF has. You could, take that access mechanism, but that's not how we create value in the Hyperliquid ecosystem. We actually create value not just through, exclusivity of access, but primarily by creating value that no one else is creating on their own. And that is the entire ethos of Hyperliquid itself. And so that's just such a critical thesis to understand. And that's why I think the potential is so significant. The question is how is the leadership going to execute on this? And I would be watching closely as they continue to develop these relationships. I actually want James to talk about one of the relationships really fast as it relates to the hyperliquid strategies and also the trade XYZ, and break that down a little bit more and how you've really seen a lot of these factors develop in the ecosystem as well, and kind of break those down from your side of things for what we were just talking about.
Yeah, I think all that was like a really good recap of like the moment we are in right now for them. And I really like the idea that this is Hyperliquid Strategy's chance to take the reins and say, hey, we have this embedded leadership optionality that other ETFs are not going to have. And I think so far they've done it good. One thing that I think is a little like nuanced, that I look back over the chart of PER and I think to myself, okay, they've proven to be based, experienced, patient, and able to kind of establish the playbook and run the playbook in a positive way that has kept them as one of the only DATs ever that have been like completely, mostly positive MNAV and outperforming over time. So I think they've proven that, but they're going to need to, prove to the world even more that like, hey, this is where you want to park the money because of our ability to use the networks and the history that we have within New York City, within the digital ecosystem, the TradFi ecosystem. And I think a good example of how they're able to use their presence so far has been this recent partnership with Trade XYZ, which if anybody doesn't know is like the leading HIP-3 deployer of these real world assets, right? I mean, by far and away, the leading. I mean, they're just taking every ticker essentially. I don't know if you noticed, but they have to win an auction for a ticker, right? That's costing 20-25 grand every time they want to put a ticker up there, and that will continue to expand in price. And the leaders are going to be the ones who win these auctions, and it will just beget more and more popularity and liquidity for them. And they've recently partnered as a validator partner with PER. So it is going to be, everybody in the digital ecosystem knows Shoku and what he's doing with Trade XYZ, and like kind of like him as this kind of on-chain Web3 dude, right? And then you got PER, which has a little bit more of maybe an old school TradFi feel to it. And this combination, and they're going to have this validated spot where people can go stake their Hyperliquid. And there's only 24 slots. If you know like soccer at all, the Premier League or whatever, there's only a certain amount of spots for teams. And if a team comes up from the bottom or like the secondary league, they kick out somebody from the Premier League, from the top league. It's called getting relegated, which is basically the same thing that's happening here in PER. So I fully expect their validator to become one of the really well-established combined entities there, and they'll take one of the top validator spots over time, which will then bring in a ton of hype tokens, and they'll be able to generate more from there. So they have a lot of embedded optionality, and I think that's at an inflection point where they need to take that spot, claim it, and I think it could be a really great moment for them, or maybe not. We'll see how it goes moving forward.
Yeah, I think the crown is theirs for the taking.
Mm-hmm.
So I'm excited to see, really the next stage of iteration. And this comes back down to the entire idea that I lay out in every single live stream. And again, if you were here, you know that in every live stream, I always lay out that my goal at Capital Flows Research is to say, let's map the macro regime and take asymmetric bets within that. And if you can do those two things, you will be incredibly successful over time. And so mapping the macro regime means understanding what are the changes in macro liquidity that is pushing capital out the risk curve, what's creating risks of bear markets, and then within that, and saying, well, what is changing right now on the upside and downside? You go to those and say, how can I find the most asymmetric bet that becomes home run trades? Because at the end of the day, the way that you make outsized returns is not by trying to get one extra trade, trading an extra 30 ticks in ES. The asymmetric bets that come as home run trades are when you are able to identify a massive opportunity that has incredible potential and take the risk and ride that trend for a prolonged period of time because you get paid to hold risk. As we're in this period of time in the financial industry where the entire industry doesn't want to take risk. They're fundamentally about volatility suppression. They don't want to be the guy who actually is able to take volatility and hold a position. And every single time I talk with someone, and they're, running some type of fund or, whatever it might be, you have this amazing fund or amazing position and it, it 5X's from their entry and you say, wow, you're going to hold that position? And they go, no, it's too big of a position size. I have to sell it now. And you say, well, why? Do you think it's going to go down? No, I actually think it's going to go up another 5X and I wish I could be long. And they're like, well, why don't you hold the position? It's just, it moves around the portfolio a little bit too much, or I just can't handle it mentally, or, oh, just like the industry wouldn't appreciate it, or, oh, investors don't want to take, volatility, even if I make them 100% return a year or something like, they just don't want to take the risk. They don't want to take the risk. And so the reason why there's an entire industry around identifying alpha, especially in terms of mapping the macro flows and talking about this. And again, we're going over all of this stuff every single day. And there's no one else that's going over all this stuff and actually doing it on live streams in real time. Because all the guys who actually want to do that, they don't want to get on a live stream, right? They're, especially in the entire proprietary trading world or even private family offices that are now taking more strategies where they take more risk and more vol, they're not going to hop on a live stream and go over all of this stuff. And so the entire idea of Capital Flows Research is to go over all of this stuff. We'll be going over how all these things function every single day on the live stream. And the entire slide deck that I share every single day, you can get at capitalflowsresearch.com. It's on the website. I lay out all the proprietary research for paid subscribers there as well on interest rates, equities, and the structural situation as well. And, yesterday, the thing that I laid out was this entire idea of the impossible trinity and how the idea of monetary independence, FX stability, and capital mobility frame how macro liquidity and cross-border flows function. If you did not see that video, you need to go back and review this entire slide deck, video, and everything else, and how it relates to every single country across the world. And if you want to go through that entire breakdown and how it works and everything like that, you just go to capitalflowsresearch.com. The Impossible Trinity Behind the Meltup is the article I published yesterday, May 11th. You can go there. The entire recording is right here. The entire breakdown summary of everything that's in the video is right here. And then go through James's video that he just published here on implementing this entire idea that we've been laying out. And then go through the entire slide deck, download this slide deck, feed it into AI, right? Like you have the ability to be creative, take an idea here and run with it in a way that, again, this goes back to the same thing that Per has the opportunity to do right now. How can you differentiate yourself from other people? How can you take what is being laid out here every single day and be able to take it and run with it with yourself and integrate it into your own edge? And by the way, I have a lot of people that tag me sometimes. I would love it if more people did. If you tag me for any idea that you see in my work that resonates with you, or if you build out any models around it, if you build out any charts, tag me in it, especially if it was in my live stream or if you clip a video from all the live streams that I'm doing. If you tag me in it, I'll retweet it. Or if you share models or research that builds on what I'm doing and it's providing value, I'll retweet it. And so if you have any of these ideas that you're building on yourself, then I would encourage you, spend time figuring out how you can differentiate yourself, tag me in it, and I'd love to go through it myself. Because there's been tons of people who have messaged me about ideas. I end up going looking into them, and then I put on a trade myself. So this is always a two-way street where all of the live streams that we're doing, all the research that we really provide, all of that just is going to get better and better as you guys continue to get better and better as well. And so today, the thing that we are building on is this entire idea of the macro regime that frames how companies like Hyperliquid and Hyperliquid Strategies, as well as the AI impact and retooling of the economy and impact on financial markets, is beginning to connect to all of the factors that we have laid out yesterday. And so yesterday was the framework. Today is the map. Every country's impossible trinity position forces the pressure out of a different pipe, whether that's FX, AI CapEx, or sector beta. This is really key because right now we have this entire idea about the AI arms race. And so a new mechanism that is taking place, especially between countries, is AI infrastructure spend is the largest single cross-border capital flow of 2024 to 2026. And where it lands is going to dictate a lot of this idea of the impossible trinity, because people are going to spend money where we have data center build out. And on top of that, people are going to invest in countries where the growth is accelerating because of the AI CapEx build out. And so you have countries that are, obviously the US is one of the main ones, but when we begin to connect these to the larger picture on the sector basis for FX and things like that, it's going to make a lot more sense. And so when we think about the trinity, the impossible trinity that we went over yesterday, we want to begin to connect that to where we are in the macro regime, which is 1, AI CapEx, and then 2, sector beta, and then 3 on this initial side right here of what's taking place in FX. And so what we have seen is the DXY had the initial rally during the hiking cycle of 2022. At that time, AI was beginning to make its play, but now we're really seeing the strength and adoption of it. And the idea here is that we are seeing the NASDAQ and tech outperform and be the leader in this entire period of time, which is going to be important to watch with these FX flows. And when we look at, when we look at what are the drivers going to be for FX, and I actually want to go back to my Twitter page really fast and pull up this tweet that I just sent out, because this will begin to help you understand the significance of where we are at right now. Here we go. Okay, so this is the tweet that I put out earlier today. And I said, FX will signal when the next bear market comes. Right now, it's signaling a continuation of the melt up. Macro liquidity is not contracting. And then I linked the video that I published yesterday. The reason that I said FX will signal the next bear market is because you have to recognize that the individuals that are buying semiconductor stocks or all these other names, again, when you have these types of parabolic melt ups like this, where, SMH just rallies so aggressively to the upside in this manner, this is not just US investors bidding it up. This is foreign investors and a lot of different global players bidding up the sector, because they understand that it's not just about getting long or short a stock. It's about establishing dominance in the AI arms race. One of the things that I laid out in the report and live streams last week was that if you're not developing AI and just sitting on the sidelines, for example, like Apple right now, you are actually risking losing a significant competitive advantage. Now, maybe for Apple that doesn't happen all at once because they already have a moat and it just happens incrementally, but people who are not on the, or they're not aware of the different changes that are taking place and why they're taking place, then they're at significant risk, because it takes a lot less to have someone get fired from a job than it does to flip an entire company in their kind of competitive moat in a sector. And we're already seeing layoffs begin to take place. And so I don't have a doomer view where I think everything is going to, AI is going to be the end of the world or anything like that. But if you are not adapting to the environment to take advantage of what's taking place, then you shouldn't expect things to just get better and better for you if you're not on the right side of adapting and providing the solutions for things to get better and better. When we think about how this connects to macro liquidity, there is going to be a very important distinction to understand as it relates to the US, the euro, the yen, the pound, and also the Chinese currency. And the reason why is because we have different drivers in different moves taking place. I put a chart here of the dollar and different differentials that are connected to the moves that we have been seeing. So for example, rate differentials for the yen. Right now, the biggest divergence that is taking place, Paul Tudor Jones even talked about this in his interview, is taking place where the primary divergence for why we are seeing rate differentials move without the currency move is because we have so much government spending in Japan. Once that gets priced to perfection, then you are likely going to have the yen rally. But for now, the yen is likely moving lower as you have the credit cycle melt up continue. Once that shifts, it will be an inflection point. And so you can go through this chart right here again. This will be laid out afterward, and you can go through all these charts yourself. And you can go through what are the major FX drivers I need to watch in this period of time right now. AI CapEx is not just a sector. It is a cross-border capital flow where the money land is decided by a lot of this impossible trinity idea, not just innovation. And so we've had billions of dollars in infrastructure spend, and now what you're having is a lot of foreigners invest in all these names, whether they're coming out from IPOs in public markets or in private markets, and you're having a lot of these hyperscalers be the primary mechanisms that people bet on for CapEx. And you're having these names pull in cross-border capital, and all of them get net long the same names. So what you're doing is you're cross-collateralizing cross-border flows with the entire AI CapEx build-out. And the idea here is that the entire industry is trying to create cash flow as fast as possible from the CapEx build-out because they don't want to hit this wall where they don't have any cash flow to prove for all of the investment that they just made, or the cash flow is not in the time horizon that everyone thought it would be. At the end of the day, it doesn't really matter if you were going to have your mortgage payment in 3 or 6 months or 12 months or whatever it might be. You say, oh, well, I'm going to be able to pay off my mortgage, or I'll have the money to pay the mortgage in 12 months. So can you just wait? Whoever is collecting your mortgage payments or rent payments or whatever it is, they're going to say, you got to go. I don't care if you're going to have the money in a year. You have to pay right now. And so timing for these different changes is just as important as the risks around themselves. People that are saying market timing doesn't matter. I mean, you're timing your mortgage and rent payments, so I assume it does matter for your life, and you're just ignoring it in some areas. And so when we're thinking about AI CapEx flows, I'm watching this really carefully because when you have these different countries and their FX flows move specifically into the United States that is having a lot of this mega cap tech build out, it is a pretty significant cross-collateralization that is taking place for all of these flows. And so the idea here is that AI CapEx build out. Here's a chart of all the FANGs, and then you have the NASDAQ. You have a pretty significant divergence, and then you also have the NASDAQ, which is the US tech, and then you have every other name below it. You can just see how significant of a divergence has taken place between all of these different names, because people in these other countries have made a lot more money, but their equity indices have not moved up because they've taken their capital and put it into US indices, which is why we have actually seen, one of the reasons why we've seen valuations at all-time highs in basically for human history in US equities. And so when we think about how the different sectors connect to cross-border flows. There's going to be several signals that I've broken down here, and I'm going to lay them out initially, and then I'm going to give you this entire slide deck to kind of cover on your own. And the idea here is that the US has certain sectors, the EU has certain sectors, same with Japan, same with the UK, same with China. And what you want to do is begin breaking down how each of these are functioning, how they have capital that is, for example, this goes back to the entire idea I laid out yesterday. Give me 1 second, guys. This connects to the entire idea I laid out yesterday, which is that once we have a move down in crude, so for example, notice that crude is up on the day. And let's see here. Here we go. Crude is up on the day. And as crude is up, what is taking place? Sure, you have US equities down a little bit, but notice specifically the DAX has a lot less upward momentum. Same with Euro stocks. So it's not surprising to see it pull back a little bit. But why is that? It's because Europe is fundamentally short energy. And so it has less exposure to all these build outs than the United States. And when you have crude bid a little bit, it's going to put more pressure on these. Inversely, also another reason why you have, the Buxel contract making a new low on the day for short term and long term, because we're having now hikes priced in the forward curve. And again, if you are a paid subscriber, you know the entire logic I laid out for this. I actually put a message out in the chat this morning for how to think about the flows as it relates to crude, bonds, and equities. But the idea here, and you can see bonds here, still not made a new low yet, but we're close. The idea here is that if we begin to have crude actually sell off, the biggest short squeeze is probably going to occur in the DAX and Euro stocks. And also probably gold to the upside, which people are not really ready for, because we're already having metal beta begin to rally. We're having copper almost hit a new high, all-time high. Yep. And then silver as well, which is already beginning to bid up. I think that's going to continue higher. And then I just think gold is going to continue to bid up as well and remain above these levels right here. And so, again, this goes back to hyperliquid. Just look at how these different changes, especially when vol begins to rise and blow out, well, who's going to be the beneficiary of that? And you can see right here, crude and gold and silver and copper, and their market share of HIP-3 volume in hyperliquid. So all these things are just very important to be watching right now, especially on the hyperliquid blockchain. I'm watching really closely. And so when we move to this entire side of these different sectors, I laid out how you want to think about the different sectors in each country, and we're going to connect that. I have all the charts here, so you guys can go through those on your own. When we pull it all together, the US, it has and really sets the globe for the impossible trinity idea that I laid out yesterday. Simply put, if you didn't watch that, the bottom line is that all central banks are converging around the Fed because of how global trade is set up. With that being said, when small changes happen with things like AI CapEx build out and how that impacts interest rates, it reverberates across the entire system. Hope that makes sense now. The FX drivers, I've laid out an entire category where you can go through these and say, what's the FX driver? How should I think about the AI flow? And then how should I think about sector absorbers within each of these countries? You can go through these on your own and begin to say, okay, well, when we have these different changes, whether that's, for example, China, and they have a closed capital account, and you have, really only internal AI flow, and you have these companies betting on them themselves, and then the property sector being the main sector that's absorbing negative things, you can begin to say, okay, I kind of understand how the flows function in China. How does that connect to these other countries right now? And if they're a net exporter or a net importer of energy or just the overall trade balance. So this breakdown right here is going to be really important to cover and to think through after the slide or after the live stream. And again, that'll be all laid out on the website. I also have a driver here if you want to go through the different countries and the import versus the AI directional flow versus sector concentration and things like that. Those are going to be important to think about as well. I'm trying to put a lot more quantitative kind of metrics in the slide deck so that you guys can spend time thinking about them, and you can also feed them into AI. If you ever feel intimidated by anything and say, this seems like a lot, I don't really understand this, that's a great place to be, because all you need to do is ask AI and you get to learn something new. And you just want to keep pushing yourself in this realm. So this is the kind of the entire idea that I wanted to cover today. And now I want to connect it to how should we think about price action? And again, this entire slide deck, it'll be available on the website afterward. Let's walk through how we should think about price action right now as it relates to the CPI print that came out this morning. So the CPI print that came out this morning came out, basically in line, a little bit above expectations. All of us knew that crude would push up the headline number a little bit. But you'll notice that after the CPI print came out this morning, what we have had is now some downward price action in equities. Now, you'll notice that that has overlapped directly with the downward move in bonds as well. And you need to ask, why is that taking place? And the answer is that when stocks and bonds are down like this, it's because you're having more inflation get priced into the system. And right now, the higher interest rates are beginning to drag on the higher equity valuations that exist. I'm going to pull up what we're seeing right now with inflation swaps. And notice right here, pull this up right now. Here's a chart of 1-year inflation swaps. Here's 2-year inflation swaps. And what you can see is how this frames the entire situation we're in. Inflation risk is still pretty significant right now. This is likely to move higher right now. That's where all the momentum is pointing. And we had a little bit of inflation tick up in core CPI. So when we look across the curve, long-term inflation expectations, not that significant yet, but on the short end for 10-year or for 5-year, 2-year, and 1 year, they have risen pretty significantly. When we look at the longer-term chart, you can see that we are not in the same range as we were in the 2010s, where we were always hitting that 2% goal. So this is now the situation that we face with Kevin Warsh, which is why, again, if you're a paid subscriber, and I sent out a message this morning and everything else, that I don't want to be long bonds right now. I'm actually neutral to bearish the long end, especially. And the impact that can have is that bonds are dragging on equities just marginally. There we go. Just marginally on the day, in a similar way to 2022, because we're at all-time highs in equity valuations. And that's why you have the euro down a little bit. Now, the idea here is that this could all go away very fast or stay on for a lot longer than people would like to think, all leveraged to this idea of crude, which has just been chopping in this range. The longer it stays in this range, the more risk that we have. However, if we have a sharp move down, we're already higher in equities. If we have a sharp move down, it is going to cause a massive short squeeze in equity positioning as well as FX positioning. It will cause some in rates as well, but specifically in FX as well as the equity side. And let me pull up the other chart that I have here where you can see that, this is why we're not seeing a massive divergence yet. Notice here, this is a chart of FX volatility. And you can see here that crude vol in turquoise is higher. Every other vol metric has moved lower. Why is that? Because everyone knows that the initial impulse is faded, and now we're dealing with the secondary effects. So when we're dealing with the secondary effects and we need to say, okay, well, what's taking place? Can little moves up in crude drag other vol metrics up, and we move up and down, and that pulls these up down just a little bit? Yes, it's possible. However, when you have vol crush like this, and capital move out the risk curve and carry trades begin to get a lot more aggressive, that is why we have had the melt up in equities that we have seen, and it's why they're likely to continue moving forward. And so that is going to be a continued theme that we see over and over. Notice just the fact that right here, when we look at, let me pull this up, when you look at 1 year OIS swaps, just think about those as, if you're like, oh, I don't even know what that means. Just think about it as, what is the forward curve pricing for hikes or cuts? If it's going up, you have higher interest rates. If you're going down, you have lower interest rates. That's all it is. Don't let anyone complicate that. Right now, what we have seen is interest rates move up, but the dollar has basically remained at these levels. It's come back down and it hasn't moved back up. That is an indication that we are not seeing a broad macro move and we're seeing more dispersion. So the implication of that is that we are still seeing a lot of support for the credit cycle and macro regime that we're in, and it's unlikely to change in the near future. If the signals begin to change and my strategy begins to shift and say, okay, well, there's a lot more risks building under the system, vol is beginning to blow out, and we got to, really switch, then I'll shift my stance. But right now, my view and my exposure and my stance continues to be long risk assets, and all the other positions and kind of views that I've had, I laid out in the chat this morning for paid subscribers. And then I'll also, as you know, all these charts and decks and everything, I'm going to lay out on the website afterward at capitalflowsresearch.com. So I know we just covered a lot. I want to go over a couple questions, but James, I know we just covered a lot there, but what are kind of some of your initial thoughts when you kind of begin to think about these different factors, these different moves that are taking place right now, and how to conceptualize them?
Yeah, I think pull this screen up here. I think this is a good crude is, I feel like crude is steering a lot of the boat right now. So if we're in like a little bit of a price action chat at the moment, I think this gives you a good idea of, like, historically speaking, since the great financial crisis, different spikes in the oil volatility, right? So we've had like this kind of the big banger obviously was when crude went negative, right, in 2020. But outside of that, we've only had these rare occurrences where oil volatility spiked so high. And think of all the different conflicts we've had in all the different regions, right? Now, if you zoom in to this recent thing, there's still a lot of crude volatility to be sucked out of this whole situation here. So when I think about that, and then I look at like where we are in crude at the moment, this is where you get into a little bit of a bias, but I feel like there's a lot of positive catalysts and necessity for the administration to really put the pressure on oil not going and making a new high or even getting close to a new high from here.
Right.
So when I start to think about that, I'm like, all right, well, if I'm leaning towards that being the case, like my invalidation is like pretty easy for me to say, like, all right, well, if we get back above 110 in crude or something like that, there's probably going to be some sort of other negative catalyst here that propels that. So in the meantime, I'm kind of leaning towards building up short positions. I actually added to a short position in crude today. But then that leads into all the other asset classes, right? If it's tugging on rates, if it's tugging on the dollar, and if it's pressuring equities, I'm kind of looking at it. A quick side note, yesterday we had a day where equities were going up. Everybody was texting each other saying, what is the thing I should be buying right now, right? In the huge melt up. And of course, that led to an interesting spot where VIX was actually up on the day and VVIX was up on the day. And we all know sometimes it's not a necessity or not a for sure thing, but sometimes we'll see this melt up scenario where the VIX or the equities start to go up significantly. VIX also rises and VVIX is rising, leading into a Tuesday in which we had a CPI come out just a little bit above expectations. And it kind of set up for this perfect kind of rolling over in my eyes when it comes to like equities. So you have that combined with crude bidding here. To me, this is another setup of trades that I've been taking for the past couple of months. It's basically whenever I've seen a spike in oil, I kind of go through this theory or this thesis, synthesizing everything together. And I just kind of like, well, if there's some spots that I like to be bidding for whatever sector you're looking at, the pullbacks are the times I think are really good to get in there, because it's sometimes hard to buy these absolute crazy breakout highs, right? Because it's hard to mitigate your risk there. But that's how I'm seeing things right now. I think it is in line with quite a lot of what we're talking about over the past few sessions. And then, but man, you were pulling up, what is it, UB? There's interesting spots in here, huh? Like very interesting spots in UB and ZB. Maybe just enough to where we see a little bit of a scare come, right?
Yep.
Oil's rising. Maybe this kind of breaks. Maybe you see another day where equities get pressured and rates go up, and you get everybody talking a little bit more about it before we get another spot where you can really aggressively bid. So I find it to be a really interesting point in markets right now.
Yeah, I agree with that. I think to your point, that we have a perfect situation, especially in equities, where it's why you want to be on sides already, right? That's why, being able to execute at extremes that we were talking about weeks and weeks ago before the melt up, before all these moves, is so important, so that you're on sides and you actually have an advantage, and you're not saying like, well, I need to buy right now or else I don't have any exposure, and then the next day it just flushes, right?
Mm-hmm.
We always have short-term flushes to wash out all the weak hands before you have the actual durable move to take place. And that's what we're seeing right now, in my view. I mean, I don't, the move down today is not, I'm not going to short equities, but I'm not surprised by the move down today. I mean, what do you expect after day after day after day being up and green and green? I mean, and then now you're shocked because you're like, oh, wait, a red day? Like, how's that supposed to happen? Like, really?
Mm-hmm.
That's how you came into today. So I think that it's just super important to understand the macro drivers with foresight and continually track them and be able to get on sides. And guys, this is nothing's dumping right now, really. This is not like oh, well, there's blood in the streets, there's issue. Like, we're barely down in the day. Like, we're down, 70 ticks in ES, and a little bit in NQ after we're pulled back a couple percent from all-time highs. I mean, after we just had a 17% rally. So we're down 2% after a 17% rally from the lows. This is not, we're not dumping, guys. Maybe on an intraday basis, you have a wider range that what you had over the last 5 days. But again, you need to put these things in perspective. And these CPI prints, again, if you know how the inflation risk in the system is functioning and how if bonds go down, they can drag on equities a little bit. Go to the subscriber chat on the Substack, then you'll know that, and it's not that complicated or that far of an idea. So what I would just say is that, like, if you're going through all these different factors, if you're showing up to the live streams every single day, if you're going through all of these different research pieces that I'm publishing, then you're going to understand the context to be able to take informed risk. And that is always going to, just getting the context right is what is going to limit you from making really, really bad decisions. And I think that is just going to be the key thing over and over to think about is, what's the context that I'm in? Okay, I know we're in a credit cycle melt up where we can have short-term pullbacks. And I also know that I want to be careful just panic buying something, because I know during this period of time that during this period of time, you can have pretty crazy moves on either direction. And until the macro forces change, I think things are moving to the upside. So that will be, just really key. I don't think silver is dumping right now. I think it flushed intraday barely, and I think it's going to keep moving up higher. And again, nothing too crazy. James, can you pull up Circle on that chart? I know we were talking about this yesterday, I think, or the day before. I have a tweet. I mean, people can go search it on where, when I was originally talking about Circle. I think Circle is going to continue to be a pretty significant beneficiary of all these changes that we are seeing taking place, especially on the agentic side. And, my view is we continue to move up higher. I've been bullish since I think it was like the $60 range, and we've doubled since then. I think we're just going to continue moving higher. We've made a pretty decent base, and so I think that's going to just continue.
Especially with Clarity's coming up. That's probably one of those things that'll have like a little bit of a noise around it, is stablecoin issuers and things like that.
I think this is just a good comment to kind of touch on before we wrap things up, is that everyone, has a time horizon of 1 day if it's a red day, which is it's just kind of funny. Here is what I would say. I think that the most important thing that you can do in markets is, number one, get the view and macro drivers for that view correct. Then overlap the correct expression and timing of that view, right? So if you're not thinking about the timing of your view, then you're not thinking about why you actually get paid in markets to provide liquidity. And then on top of all of that, you need to have a very clear decision-making process to be able to manage your own mindset, manage your own emotions, so that even if you have the right information, you're not just panic buying or panic selling at the highs and lows, and you're able to work through things in a really informed way. And so, the entire goal is, I'm laying out everything on the website at capitalflowsresearch.com, and you can find all of that right here, right? All the educational primers are right here. All the articles laid out every single day with the slide deck and models and everything else are here. There's interest rate models, equity models, every single type of model you could think of, and book recommendation and primer in here. So you just need to go through all of these, read all of them, and then go through all of the work that James has done on his YouTube channel. And especially the most recent video, I think it's a really good one to kind of think about how to trade and win during these huge moves that are taking place. So that's a really important one as well. So I would encourage you, spend time going through both of those resources and spend time showing up every single day. Again, these live streams are every day, 8:30 a.m. Mountain Standard Time. And we're going to continue showing up and bringing you just really exceptional insights. I'll continue bringing all of the FX flows, interest rate flows, especially as we're moving into inflation. I think the key thing that we're really going to focus on is, at what point do we begin to have things roll over and the bull market become unsustainable? That will be one of the key things to watch for really closely, because when that time comes, it's going to get bloody. But for now, we still remain in a credit cycle melt up where rates, FX, equities, and liquidity and credit, every single factor is pointing to one thing, and that is further upside in this melt up that we are seeing. Once those factors begin to shift, I'll publish a report on it and publish more on that. But for now, on the live streams every day, we'll be continuing to lay out updates on that view, how it functions, why it is that way, and everything else that we'll be covering. So, James, final thoughts, ideas as we pull things together.
Yeah, just pull that chart up one more time, because I want to reemphasize here.
Yep.
Like, think about, I would implore, if you're struggling today and your positions are getting whacked, and maybe you did some stuff in the recent week or whatever, I implore you to think back over this move. Now, by the way, you said it was like 19%. It's more than that. NQ move 29% in the last 30 days,
Yeah,
which is pretty absurd, right? So I want you to think back of what you were thinking about here. What was your mindset here, right? Because we were discussing around here about how we think this is actually a constructive place to be long. All right, like we were comparing it to the April tariff tantrum, which is that fractal you see back there. We were building positions here, right, or adding to them. What were you doing around here? were you convinced that this was a turn in the markets? Were you scared to actually re-enter positions? Were you bear hold and just thinking that, no, we're going to turn back over here because insert whatever reason? And then what happened in these last couple weeks for you? Did you buy breakouts? Did you say, no, I don't believe it? Did you finally get convinced up here to say, fine, it's a breakout. This time's different. I'm going to buy all these AI stocks that are running? Well, if you did, I'm going to guess you're either break even now or down, especially because of what people have been buying lately and how much they've been flying. Right. So I think this move is like a really important move to just go think about. Where was I'm going to put out a video tomorrow. I'm going to record it today about the 3 like most unique insights I've had over my, figured it out, it's like 20,000 hours trading, right? 3,200 trading days since 2013. And one of the biggest insights that I've had, and I'll share it here, is second and third order derivatives of mistakes, second and third order like consequences, right? It's never often the first mistake. It's often the compounding mistakes over time. And if you could go back, try to figure out, where was my first mistake here, right? Because you might have put it on a position yesterday and like, whatever, let's go to Intel. Let's just check out Intel real quick. Intel's down 10%, right? Now, this is still in a bull trend. It's probably going to do fine, whatever. Maybe you finally got convinced after 15% up days, 10% up days that Intel was the best play in the world, and you bought it in the last couple of days. Well, maybe that mistake that you're staring in the face today was because you weren't in the process of thinking properly back here. And it all led to you taking a position today at Intel, or yesterday in Intel, or the day before, or whatever, right? That's a compounding effect after a breach of process and not thinking clearly. And this pressure that we always talk about, markets apply pressure to you in the worst of spots, built, and you capitulated here, right? And I just find it really interesting to think about this whole segment of time and stuff. And if you could go back and figure out where exactly you botched it, right? And be honest with yourself. So I don't know, just an interesting thought process for you to help you as a trader.
I think that's just so good. I think that's just such an important progression to think about, a really good evaluation. And maybe you did the opposite of all the mistakes, and you said, oh, I was constructive, I actually added to a position, I've been holding, now we're at highs, and I've actually scaled out a little bit. Maybe you've done that really well, and you can look back and say like, oh wow, I'm actually building some confidence, and I get some reps under my belt, and I feel like I've played this really well. And there's still a lot I can learn from that about, maybe I could have done some little things better, or whatever it might be, right? But I think a lot of people would probably be in the other situation where they were just probably bearish at lows, panicked, chased, and probably put their stops too tight, and got whipped out a couple times, and then chased at the highs, right? Because I think that especially if you're just trying to intraday trade and you don't know how to get on sides intraday or understand all these macro drivers intraday and intraweek, and you're just trying to come into the order book and the chart and just say like, yeah, let me just try to find it when we are kind of like down a little bit intraday and just buy a low and then just hope for the best, right? Like, it's just not really going to serve you well in the long term. And you probably feel that, right? You probably feel a little frustrated because maybe it helped you once, you made a bunch of money, and then you've given a little bit back. And I think the entire thing is, how do you orient yourself toward this entire process that James is talking about how are we beginning to think through that? I just think what you just laid out was just really, really, really good. I think people should just watch that over and over.
Yeah. And then we talk about experience, right? Time in the seat. How many times have we seen things like this? Like, I'm looking over it, right? We've had so many of these V-shaped recoveries since 2020 that we've gotten to see and feel all of those things over and over and over. And that's going to help you in this position right here, right? These are the key spots, like key extremes. And if you could figure out, through your work and stuff like that and your own time and effort, it's going to help you during these moves, right? This is where the riches are made, during these times. And if you've made mistakes down in these times based on your thought process and how you approach markets and all that, you're just going to be finding yourself making mistakes. And you're going to look back and be like, wait a second, we're in a massive, what do you call it? Secular bull market. And I'm poorer than I was back here. Right. So I don't know. I just made a goofy artwork there, but I think you get it.
I like it. It's the visual representation of how to what is it? Right curve, left curve. We have my slide decks, and then we have these from you.
There we go. This is left curve trading right there.
Left curve trading. We got the right curve slide deck. You can purchase this trading view visual on eBay as an NFT.
There, the louts on bread.
Stay in the shot. I love it. Awesome.
All right.
Well, everyone, thank you for joining today. And we covered a lot. I would encourage you, right after we're done with this live stream, go back to the beginning, especially if you came in late, and go through the recording and begin to think through the different factors that we covered, how to think about them. I covered the PER idea. I covered hyperliquid, covered cross-border flows. I went through the entire slide deck. That slide deck will be sent out on the website afterward. James covered a lot of the work that he's been laying out recently. Just continue to just invest in your own success and how you can take accountability in the process that you're building right now. So that's what I encourage you, challenge you to do. We'll continue to do these live streams every day. And next live stream will be tomorrow morning, 8:30 a.m. Mountain Standard Time, and we'll be covering more on the macro regime. So with that, we will catch you guys tomorrow.